Hey, what's up, Market Moose? Mark from the Moose on the Loose. I hope you're doing well. Today, we complete this mini series on the Brookfield. So, last Thursday, we had the big overview of all the Brookfield family. Then on Monday, we discussed BAM and Brookfield Corporation, BN. Yesterday, it was all about Brookfield Renewable, and they actually published their earnings today. So, you have to take a look at that. And if you want to know how to analyze it, just go to yesterday's podcast. And today we close this series on a deeper look into Brookfield Infrastructure, so BIP or BIPC. If you want to know the difference between both, you can actually watch yesterday's video on YouTube or listen to the Moose on the Loose podcast from Wednesday where I explain the difference, or you can actually download the complete guide to Brookfield Inside Out. It's a free guide. You just have to register for my newsletter. You can do that at dividendstocksrock.com/Brookfield. So the link will be in the description below as well. So dividendstocksrock.com/Brookfield. All right, so BIP, what's in it for you? Well, it's one of the largest infrastructure operators in the world. The company aims at generating a total return between 12 to 15%. So that's quite nice. When you look at the investor's presentation, you get all excited because what kind of investors doesn't want to have a 12, 13% return over the next 10 years on their investment, right? It's not exactly how it goes right now, but still not doing that bad. There's less of a hype than it was for Brookfield Renewable, because renewable, as I told you yesterday, it's all about powering data centers and AI computing. So this one is a little bit different. Probably less exciting. It's up 14% year to date, offering a yield of like 3.5%, which is pretty good. I mean, you have a robust business model, you have a good yield, and then you have some decent growth because the target for the distribution increase is 5 to 9%. Currently more around 5 to 6 over the past few years, but still you have a yield that is close to the kind of like ideal 4% withdrawal. So if you have a stock generating 4% yield, you don't even have to touch your capital forever. This one is close to that. Plus, it will beat inflation with a 5 to 9% dividend increase. So kind of like the type of like the unicorn stocks that you can find on the market where you have a decent yield and decent growth, not just one or the other. One other thing that I love about this one is they are literally everywhere. So sometimes, and it's kind of funny because on the YouTube channel, someone mentioned that in the comment that Brookfield should like sell some ETFs based on their investment strategies. Well, actually, this one is definitely an ETF play on utilities. So they have 67% of their assets, so 2/3 of their assets in Americas, and then 14% in Asia, and then 19% in Europe. They have 26% of their funds from operation being generated from classic utilities, because yes, it's classified under utilities, but usually utility company is only just like electric transmission or generation. So we have only 26% of the funds from operation that is being generated from utility segment. Then you have transportation, 41%. Now you're thinking about a lot of like toll roads, and then rail operations, so railroads, and then terminals. So completely different than just providing power. You have 20% of midstreams, so those are pipelines roughly, and then you have like processing plants and then storage, and finally 13% from data center. And the bulk of their capex right now is going towards data centers, so 35% for data centers and also 46% in transportation. So as opposed to a lot of utility business, they don't lack of diversification. So if you compare it to like a company like Hydro One, for example, that serves only Ontario for energy power, now you're talking about one company that is playing across the world and playing across multiple business segments. You can get lost along the way. As usual, this is the most obvious risk when you invest in one of the Brookfield company. Unfortunately, you have some other risks to consider as well. The first one, similar to most of the utility businesses, is the interest rate or like increase or interest charges altogether risk. The company increased their long-term debt from roughly 7 billion 10 years ago to 53 billions right now. So we're talking about a huge increase. Of course, the funds from operation is going up, but still it's a complex structure. Of course, you cannot fake distributions, but you have to consider that if they hit a slowdown, there's a recession, some of their assets are not performing as expected, well, then that 50 plus billion dollars debt will start to weigh on their reports. You can think of like the railroads. Actually, it's kind of ironic because railroads right now are not exactly thriving. So if you look at CNR, you look at CP, Canadian Pacific, can look at CSX or Union Pacific on the US side as well. The railroads are not thriving, of course, because we all expect an economic slowdown. So for those reasons, when you think about the fact that Brookfield Infrastructure is investing massively in this, well, that comes with another risk. They play a patient game with an impatient market. So the risk here is to kind of feel the pressure. You invest in this type of business, the stock is not performing, and you become impatient. The market becomes impatient, and then you have this urge to sell and move your money elsewhere. So if you're not in for the long term, it's going to be a very frustrating and difficult holding to keep in your portfolio for that reason. And finally, one last risk. Of course, they are doing the asset recycling strategy that I've explained with Brookfield Renewable. They're buying assets, they are improving those assets, and then they're selling them at a added value to recycle the capital and invest again. It's all great on paper, doesn't always work this way. So sometimes you make bad acquisitions, sometimes you pay too much, the integration doesn't go as well, or you're not able to sell it as expected, or the market is just not there for you to sell. So all of those factors could also hurt Brookfield performance short term. So the company is reporting this Friday on the 7th. So what to look for in this one? Well, you have to look again for the funds from operation and funds from operation per unit. So we're talking about FFO and FFO per unit. Super important. Look at which kind of deals with where the money is going in terms of asset recycling, data center development. Those are the main narrative right now. Besides that, it should pretty much be business as usual in terms of like the overall business. Probably expect mid-single digit to high single digit funds from operation growth. This is usually where Brookfield Infrastructure sits in. This is not the type of stock that will push your portfolio towards new high and lead the march towards profit, but it is a very decent company offering a decent yield and some decent growth. So again, if you want to go and do a deep dive into each of those Brookfields and understand exactly how they work and where to watch and which one is the best one for you, download the free guide Brookfield Inside Out at dividendstocksrock.com/Brookfield. Tomorrow, we are going to talk about one of my holdings that is still killing on the market. Recent earnings as just came out, but I'm going to leave the surprise for tomorrow. Until then, don't forget to stay invested.